We know it's important that the right mindset, education, and experience is needed to overcome the daunting challenges of trading. But what are the most daunting aspects of trading to overcome? Well, at number one, it's the rapidly changing markets. Markets are highly volatile and can make it difficult to predict and manage potential losses. Number two is uncertainty and stress. The volatility of the markets can make it challenging to make accurate predictions and, of course, accurate trades. Number three is making decisions under pressure. Trading can be an emotional experience as it involves self-discipline and not deviating from a strategy. Number four is time-consuming. Trading may require a significant amount of time as traders need to constantly monitor the markets and make decisions in real time. And at number five, which is the one I find most interesting, is the self-awareness that is required in trading, as being aware of one's own cognitive biases can be hard to achieve. So let's start off with number one, rapidly changing markets. This is when markets are highly volatile and can make it difficult to predict and manage potential losses. Now, when it comes down to trading, as you already know, there are different time cycles that you can work with, right? In terms of high volatility in the markets and how it's relative to your style of trading, my recommendation is if the markets are moving too quickly for you, for example, if you're going down here to the 2 minutes and it's going up and down and you can't kind of keep up with that, then just drop the pressure, take it a step back, go into a more reserved style of trading, and then of course go to one of the higher time frames and use that as your trading base. So the second daunting component to trading markets is uncertainty and stress. And this is caused from the volatility of markets, which can make it challenging to make accurate predictions and trades. Now, the uncertainty and stress that comes with trading is generally created from when guys feel that they have this illusion of control and think that they have any influence of what's happening in the market, right? So to some component, it's true. Like, you are making a trade, so you are the drop of water in the ocean or the grain of sand on the beach that is a part of the bigger collective. However, there are still tons of traders out there, like tens of thousands, if not hundreds of thousands of other traders who are also doing their part to make this beautiful tapestry move forward. There is a collective that is all working together to make this market possible. If there's no traders, there's no market. So don't do their job for them, all right? What you need to do is the best of your ability to make profit from this crazy game that we're in, and how you can go about doing so, and also reducing the stress of volatile markets that you may be experiencing, is to simply work from a confirmed turning point. So this turning point 10 is the low and the end of the last cycle. Then you see, once that's in and confirmed, you can do your forecast, your prediction of where you want price to go to next. My prediction was that it was going to be within this little white block over here, and how it got from where it was to where the white block is completely up to how the market wants to do that. All right. So if it wants to have this sporadic spurt up and then stop over there to kind of glide down in a sideways manner to regain some energy and then burst itself into this environment, that's completely up to it. It's not up to me how it gets there. It's up to me though to ensure that I'm working from my confirmations. Confirmed turning point, price outside a kill zone, preferably inflow with trend, and then it moving to that white block in whichever way it chooses to. I can't guide price action. So being connected to this price action and feeling the emotions of it going up and down and not according to plan in that moment, and then getting back on course, and all the kind of mental turmoil is just not worth the stress and emotional drainage that trading can offer. Allow the market to do its work. Try not get too involved with doing all of the work for all of the other traders around the world in an environment where you actually want to create time freedom instead of being too invested in this. So that's number 2. Number 3 is making decisions under pressure. As we spoke about already, trading can be an emotional experience, and it involves self-discipline and not deviating from a strategy. When it comes to the MTOPS strategy, everything that you need is right here. So kind of behind my head, I'm not sure if I can move myself there. I'm now moved. Behind me is the rules checklist. So all the rules are there beside you to ensure that there is that safety net to support you when using the MTOPS strategy. Not only that, we have the visuals above so that it's nice and convenient for you to tick like it's a to-do list to ensure that you've got all of the components of the strategy considered. All right, so the trend direction, turning point spacing, scaling, kill zone, time and cube, oscillated price, support and resistance is all there. All right, just follow the strategy and don't deviate from it, because when you do that and you are doing it in the name of not being able to have self-discipline, then the injustice that you're offering your trading account is just simply unfair. All right, so self-discipline and not deviating from the strategy is going to help there when it comes to making decisions under pressure. Daunting point number 4 is that trading is time consuming. Trading may require a significant amount of time, as traders need to constantly monitor the markets and make decisions in real time. Going back to one of the first points, if you're finding that trading is taking up too much of your time, then lower the pressure on yourself and assume less risk. And you can do so once again by using the higher time frames. All right, instead of putting in multiple trades a day, maybe you put in 1 trade a day. Instead of putting multiple trades in a week, for example, if you kind of have a busy life, then maybe do 1 or 2 trades a week when the right market conditions are there to, as I made mention to, let the market invite you in. So if that's still not adequate, then you can do so once or twice a month and so on. MTOPS provides you with the control of how to build trading into your life. Okay, moving on to number 5, which is what I feel is the most interesting, daunting component to trading, is self-awareness. All right, so trading requires being aware of one's own cognitive biases. Now I'm going to move across to a demonstration screen, and we're going to go through these cognitive biases together, because I feel that this is something that a large amount of traders that I have had direct interaction with and beyond are suffering with, but they didn't even know they were there. Cognitive biases are systematic patterns of deviation from norm or rationality in judgment, whereby assumptions about situations may be drawn in an illogical fashion. These biases can have a significant impact on traders and their decision making. Here's a list of a few examples of cognitive biases that traders may need to be aware of. So my recommendation is to definitely screenshot this. I'll put this into the description section of this video as well if you just want to copy and paste it somewhere. But be aware of these and go back to these when you're actually trading, because you might catch yourself off guard in terms of falling into one of these cognitive biases. Okay, so the first cognitive bias is the confirmation bias. So this is the tendency to search for, interpret, favor, and recall information in a way that confirms one's pre-existing beliefs or hypotheses. Okay, so from my understanding, and this is also relatively new to me and something that gave me some aha moments, is that the confirmation bias shows itself when one is unwilling to let go of bad habits. Now, if you've been a trader, outside of MTOPS and you've come into MTOPS still not letting go of your bad habits, like using channels or pitchforks or the RSI or whatever that kind of shackles and ball and chain that you kind of not really want to let go of and brought it into this environment will show up here. All right, so letting go of one's pre-existing beliefs or hypotheses when learning MTOPS is going to help you create that new foundation space, that new creation space for the actual truth of the markets to land correctly and be able to use the truths rather than the preconceived ideas that you may have brought into this. This not only applies to traders who have traded before MTOPS, but also those who may be walking into trading with limiting scarcity and lack beliefs. And that's a whole nother segment and something that I want my traders to constantly be aware of. Okay, let's go on to number 2 here. The anchoring bias. Okay, so this is the tendency to rely too heavily on the first piece of information encountered when making decisions. The anchoring bias is something I can certainly relate to. So when I am being impatient in the market and there is a turning point that is potentially about to happen, I will then put down a tool set, the Gann square in the opposite direction, and start to kind of look for a kill zone formation ahead of when it's actually ready to form. And I know this by looking at the top of the screen and seeing the oscillator still open and not showing sign of looking to switch. And I'm just like kind of anchoring in my bias to the first bit of information forming, hoping that it is where the turning point is, merely because I'm just tired of waiting for anything to happen on the markets. Now, I know that confirmations will be the answer to helping out with anchoring bias. All right, so waiting for that oscillator to switch, waiting for confirmations of price leaving the kill zone and attaching itself to one of the fan lines and moving in the opposite direction, so that it's showing good structure, and of course it all going along with the trend on the different time frames. So anchoring bias, I guess, is a fancy way of saying seeing what you want to see instead of what is, and using a little bit of initial information to be that anchor of delusion. And the bias comes in is that you want it to work out more than the market is prepared for it to work out. So use your confirmations to overcome the anchoring bias. So number 3 is representativeness bias. And this is the tendency to judge the probability of an event based on how similar it is to a prototype. All right, so that's kind of fancy jargon to say we are looking for setups that have looked good and worked out for us in the past. And this is where the law of alternation steps in. So under market structure with the trading view course, we speak about the law of alternation. The market's job is to never have the turning points form in the same place ever. Turning points will never form in the same place twice. Maybe in the same range, but never in the same place. I call this the lightning never strikes in the same place twice principle. It's the law of alternation. So the representativeness bias is when you're looking for those similarities. All right, I've had guys come to me and say, but what if China open bell dumps the market, and then India open bell also pushes it further down, and then Europe open bell will start to create that kill zone, and then America open bell makes it bullish, and then it goes back and forth. Like, the guys have really become super sad, and after doing weeks of research in this, they become super sad because they've literally come up with nothing at the end of it. And this is because the law of alternation will never allow that level of predictability to exist in the markets. And that's partly why the markets have been going on for so long, is because most traders haven't got it figured out. So looking for the similar prototypes or similar previous setups whilst in your trading experience is going to lead you into a lot of disappointment. Don't look for predictability because you've seen it happen in the past. Forget it. MTOPS is a sequential based strategy that works on the now energy of the market and considering in the law of alternation. And that's why we are so much more successful than the other guys out there who are looking for those fixed setups that just never produce consistent results for this reason. All right, so that's number 3. Number 4 is overconfidence bias. This is the tendency to overestimate one's ability to predict or control outcomes. So this overconfidence bias won't last for very long. It does exist, and most of the traders who have been using FTMO demo kind of experience this. They're just overconfident because they're going in with full conviction and jumping into trades. That's not going to last long, let me tell you, when it comes into dealing with the FTMO challenges and dealing with institutional money or your own money in the market, because the markets will very quickly humble the overconfident. Be responsible. Don't put in too big a position. Use the correct risk reward ratios and trade and trend and so on. Okay, so number 5 is the hindsight bias. All right, so this is the tendency to believe after an event has occurred that one would have foreseen it. I love this one. Okay. I love this one, this hindsight bias, because the tendency, let me read it again, the tendency to believe after an event has occurred that one would have foreseen it. All right, so this is often the case for me. All right, so if I move away from the trade and I don't trade and I come back and then I see the trade and I'm like, oh man, I would have got this. Oh man, I would have got this. It's very easy to be like the master of hindsight. Again, this is a lot more difficult to attain in real life in terms of being able to foresee every prediction work out because of the law of alternation, because of volatile markets, and because of the shifting or the way in which some price action can behave within transitions. Don't fall into that trap. I'm just speaking from experience because this has happened often to me where I've kicked myself and been annoyed with myself because only if I had got into the trade back then I know for sure that I would have foreseen this happening and won from it. And that isn't often the case in reality, because if that was the case, then I actually would have got into that trade and then I would have got that profit and then been quite happy with it. So the hindsight bias is more just something to drop because you don't want to add additional levels of guilt onto your trade experience because you're going through so much anyway. So just the resolve to the hindsight bias is just drop it. Okay. Number 6 is the loss aversion bias. So this is the tendency to strongly prefer avoiding losses to acquiring gains. Man, trading is so complicated, eh? It can be really complicated because you're dealing with so many emotional things and psychological drawbacks before you even get to just the technical analysis, opening up a trade and profiting, that kind of stuff. So this loss aversion bias is kind of those who feel happy to not do anything for a long period of time, feeling like that's how they're going to get ahead because they're not losing and they're not necessarily gaining either. So they would prefer to avoid losses than to acquire gains. Now, my friends, you're in the wrong industry if that's you. Okay, you got to put yourself out there. You got to take action. You need to start building up those experience hours towards getting in those gains. That's the name of this game. So gains is the name of this game. All right. Number 7 is the herding bias. All right, so this is the tendency to follow the actions or opinions of a group rather than independently evaluating information for oneself. Okay, so sometimes we lean into the herd mentality or the talking head mentality where someone speaks with confidence and conviction and we think that they are right because they're so proud about it. But often what happens is that, for example, if you go to a party, the knuckleheads are the most confident, right? They're the guys like, shot, you know what I mean? Like those knuckleheads are the most confident. I'm just being very generalistic here. And the smarter people are more or less more reserved, more calculated and that kind of thing. But we kind of follow the confidence because the herd mentality thinks that the most confident person is the wisest, and that's not the case, all right? So don't give in to talking heads out there who come across as strong and convincing, but in reality just going to leave you in losses. So the herding basis can also happen when you're lazy, when you don't trust yourself, where you're skipping steps. You don't fast track a process that's going to give you thousands of dollars a day, all right? You work towards it. And without getting into the whole sermon of self-discipline and dedication and showing up and being persistent and that kind of stuff, like you already know all of that, but way in which one can lose themselves along the way or create this illusion of safety net in trusting the group is by not doing the work themselves. Be independent. You're here to be your own pillar, to create that amazing influence to your communities and your family, yourself, the generations and everything else to come. So don't be over reliant to the herding environment. So the herding bias, if it is applying to you, which it can for those who are lazy or don't want to put in the work, I also recommend you drop it and rather become independent in your ability to profit from the markets. Number 8 is the gambler's fallacy. This is the tendency to believe that a run of luck in one direction is more likely to be followed by a run of luck in the opposite direction. Now, I don't know if that's a complete fallacy, but I guess if one is following the rule set and committing to the process, then the correct risk management and everything else you already know will be there to support you in keeping in those consistent results coming in. So it doesn't necessarily mean that if you're doing well that you have to do poorly again to do well again. It just means to avoid bad setups, but that should be what you're doing anyway. All right, so being aware of these cognitive biases and actively working to overcome them can help traders make more rational and informed decisions. I want to jump off now, guys. I think it's been quite a long video already. I hope you've taken notes. I hope you've had a laugh, and I hope that you are going to be more aware of these cognitive biases as well as the other daunting components to trading and apply some of my positive resolve in how to overcome them. All right, thanks for your attention. Thanks for hanging out. I'll catch you in the next video. Ciao.